new opportunities, new partners. E.G. Tax.
It's Ask the Tax Lady with Esther Gulius and E.G. Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey everybody, this is the Tax Lady, and boy, we're going to talk taxes. We are going to help you to make lemonade out of lemons because we are New Yorkers, and we want to make sure that we give you the best information so that you know what the heck is going on. I will tell you one thing about EG Tax, we know. And you're going to find out that what they did was if this all passes, and it looks like it's going to pass in some form similar to what was proposed by the House, many of you are going to find that you're going to pay a lot more in taxes, and it's so sad because upper income people are definitely going to make out, especially businesses, people with incomes over $500,000 taxable income over $500,000, but the regular guy is going to find out if he gets a tax break. It'll be because he has a kid or two under the age of 16 and doesn't have any special itemized deductions. But seniors, you are going to the woodshed, I'm going to tell you, because you've lost your personal exemption and your over 65 exemption. But anyway, I don't want to talk about that yet. We're going to get Tiffany Fabian and Christopher Fabian here, who's in studio with me. Hey, Tiff.
Hey there, Esther. How's it going? I heard you put up your Christmas tree today.
That really should be. It's like a marriage encounter when you put up a Christmas tree because you got to readjust, because we put up a fake tree, but you got to readjust the branches, then you got to haul everything in, and the bulbs are flying all over the place, and so I'll tell you, if your marriage stays together after you put up the tree.
That's right. That's why some people, as they get older, they just put up that little tiny tree, and then they don't have to worry about.
By then, you kind of, all the fight is out of your marriage. So, oh well, what can happen? Who cares?
That's
it's
true.
Not worth the fight.
That's true.
Well, hey Chris, how you doing?
Hello, Esther.
Hello, Christopher. All right, so let's tell everybody what they can do, because they do have 29 days to make some changes, at least through 2017. That'll save them some money, because I will tell you, a lot of people that have been writing off things that are in the past are not going to write off anything. And if you think that you've gotten a great big benefit because they're doubling your standard deduction, you're kidding yourself, because all they did was take away your personal exemptions. So all you're doing, if you're married filing a joint return under the age of 65, you're getting an extra $2,000 in write-off times 10%, which is saving you $200, but you're losing all this other stuff. So believe me, it's not good. There's a number of people that don't itemize. There's about only about 30-some% of the people itemize. So it's only going to affect I'm thinking maybe 15% will still be able to itemize after they do this to the tax law. But there's some categories that are not even itemized. These are adjustments that are going away. And one big thing is alimony, right?
That's right. I mean, what a deduction that the one spouse had. Normally, it's the male. In the planning of the divorce and the settlement, they agreed to the alimony being as high as it is because it was a deduction of her income.
I just talked to a woman.
The payer.
For the payer.
Whoever was the payer got to deduct the alimony. Now, I don't know what's going to happen right now. It's on the chopping block. So I would suggest, if you're somebody that's paying alimony, it's going to become a non-deductible item. And so if you were claiming 10 allowances at work to get from paycheck to paycheck, you should talk to your attorney, because if this goes away, you're going to pay all taxes on the money that you don't have.
Yeah, I talked to a woman. And it's going to be tax-free
to the recipient. So that's the first thing. Wanted to make sure that you guys talk to your attorneys if you're paying alimony, and find out how this is. If maybe the kids, of course, there is no personal exemption. So, right? Won't it make any difference if they get to claim the kids?
Yep.
And that's the first thing. The personal exemption is gone. So if you have 4 kids, if you're a family of 4, you've just lost. They've given you $24,000 instead of $13,000, but you're getting cut by 32.4 on the personal exemption end. So you actually come up behind the 8 ball, especially if your kids are over the age of 16. What happens when you're over the age of 16?
When you're over the age of 16, you lose the child tax credit, and so that child tax credit will be gone. I mean, when they're older, when the kids are older.
Once they're over the age of 16, you lose the child tax credit. So not only will the personal exemption be gone, but the child tax credit is gone, right? So, but there are things that you can do in the next 29 days to make sure that you've gotten a jump on the 2017 return, because this may be the last time you get to deduct some of this stuff until they mess with the tax law again. I'm Esther Golias, the tax lady, 803-0930. 803-0930, star 930 on a cell phone. Our toll-free number is 1-800-616-9236, 1-800-616-9236, and I know we have calls coming in. Wanted to talk about, all right, so what you want to do is, since you can itemize this year, because you're in high-tax New York State, you want to make sure that you maximize your itemized deductions. So some of the things you might have been waiting till 2018 to do, don't wait till 2018. Front-end load it and put it into 2017. Right, you guys?
Mm-hmm.
Yep, pay now.
That's right.
Pay now. All right, like
sales
for instance,
tax.
let's say that you have a nursing home bill that's coming up and you were going to wait till January. Pay it now.
That's right.
Because now they're proposing under the Senate plan that medical will still be a deduction for the next 2 years. Under the House plan, it's eliminated. So it's going to be a deduction either way, but to hedge your bets, I would suggest you get all of your medical paid as much as even if you have to put it on a charge card, if you're an itemized taxpayer, and nursing homes is one of those expenses.
That's right. It's a big expense.
Right. You know, the other thing is, nobody's even talked in New York State. I know Cuomo came out and said what a travesty this is for New Yorkers, and it is. But there is like $9,000 missing between the New York State standard deduction, which is $13,000, and the new federal standard deduction, which is $24,000, which would mean that that $9,000 would end up being taxed if you were a New Yorker who would have itemized before. So you think about $9,000 times 8%, that's $720, right?
Right.
That you're going to end up paying extra in New York. So not only are you going to get El Shaftola on the federal, but you're also going to get it on New York State. So you should also talk to your local state representatives to find out what they're going to do if this thing passes.
Good luck with that. I tried.
Okay. Hey, let's take a short break, and we'll be back with Jack and Judy and who's ever on line 3 and 4, because we're going to tell you what to do to maximize, to make lemonade out of lemons before the gauntlet, the poop hits the fan, so to speak. I'm Esther Golias, the tax lady, 803-0930, 803-0930, star 930 on your cell phone. See you on the other side. Hey, I'm Esther Golias, the tax lady, and we're going to give you the lowdown on what's happening on your taxes. And I will tell you, don't drink the Kool-Aid. This is going to help people that have no kids, that are under the age of 65, and it's going to help them moderately, unless they have substantial income or maybe a big corporation. If you have a corporation, C Corp, making $1 million, you're going to save about $140,000 in taxes. And if you're somebody whose taxable income, Mary Joyne, is $600,000 or more, you save $24,000 in taxes. But if you're a senior, you're going to find out that you're paying more in taxes, especially, God forbid, that you're somebody that likes to go
Gamble.
to the casino now and then, because there is no itemized deduction for gambling anymore, unless they come up with something in this reconciliation plan. I hope somebody's thinking about the average person, but it looks like, unfortunately, it really is a bill right now that's going to especially help upper income people. So, why don't we go to the phones? We're going to go to line 1, Judy from Tonawanda. Hey, Judy, how can we help you, my dear?
Hi. My family, my siblings and I recently sold some property in Canada, and so I have a fair amount of money. I was just wondering if I would be better off paying off my mortgage. I'm 65.
So let me ask you a question. How much is your mortgage? What rate?
I'm sorry, what?
What rate is your mortgage?
I believe it's 6.5%.
All right, 6.5. How much do you owe on your mortgage?
A little over 50,000.
All right. So
How many years left?
For about 14 and a half.
Okay. So on the 50,000, she's still paying 6.5%. So you're never going to make 6.5% on most investments unless you're somebody that likes to go into the market. Right now, the market's on an upswing. You might be able to do better by being in the market. But if you're a conservative person and you take a look at just the numbers, if you put it in a CD, the best you're going to do is 2.5% to 3%. So if you pay off your mortgage, in effect, you aren't paying 6.5%. And it sounds to me like you're not somebody that's going to be paying taxes anyway. So you're going to get no tax benefit for having a mortgage. So I would definitely think about that, paying off your mortgage. But more than anything, I think you should call our office so we can make sure that. Do you have credit cards that might be at 25%?
Only one, but it's only like $1,000.
Okay, but obviously, when you are paying off a high interest debt with money, then that's money that you don't have to pay. So in essence, you may not be earning it, but you're not paying it. So that's a good thing. So I would think that looking at that mortgage as a deduction, as a benefit, so you don't have to pay that anymore, is a good thing.
Not to mention that going forward, maybe she won't be able to claim it.
She won't be able to. She probably. Do you even file a return, Judy?
We haven't talked about her income.
But yeah, I do file a return, and I do have income coming in.
Okay, so how much is your income?
I have a pension that's like $2,400, and Social Security that's a little over $1,200.
Okay, any other source of income besides that?
That's it.
And are you a married lady?
No, I'm single.
All right, and you're under 65.
No, I am 65.
You are 65. Okay, so in her situation, only $4,800 is going to be taxable. So she's $576 would be her tax bill. She's not going to itemize. So back to that original thing, you're looking at paying off your home. I think would be a very wise thing to do.
And you haven't sold the house in Canada recently, right, Judy?
This past summer.
So she's going to get. You're going to get a foreign tax credit when you file your return. That income is taxable to the taxable to the federal and the state of New York, but you get credits for them on your federal and state returns, so you don't have to worry about being double taxed.
You're going to have to file a return in Canada and then claim that income and get that credit, like Esther said.
They've already taken out a big chunk of.
Yeah, but you still have to file it on your federal return and New York state return, and you're going to get credits for taxes paid in Canada.
Okay.
Okay.
Okay. Thank you.
Thanks, Judy. Okay, I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on your cell phone. We got Jack from Lancaster. Hey, Jack, how can we help you, sir?
Yes, could you tell me, for retire, I'm retired, and I collect Social Security. It's probably a little less than 50% of my income.
Okay.
Is the calculation on how much tax has to be paid on Social Security going to be the same, or?
As far as we can see, here's the interesting thing. The only thing they futzed with was the deductions for people, regular people. These deductions were not available to upper income people because they lost them when their income got higher. They just took away the ability for average people to deduct their medical, their second home, their employee business expenses, their investment expenses, those are gone, okay? Their property taxes, unless they keep them in. And they put a cap on the mortgage interest as well. So what they did was they eliminated the deductions for regular people. They did not change the way the income is structured. So all that income that was taxed originally is still being taxed the same way as before. It's just the ability to take deductions. And for that, they say they doubled your standard deduction, but they took away the personal exemption. So they gave you money on the right hand and took it away on the left hand. So, but yeah, it looks to me like everything's going to stay the same from that perspective.
You're saying it's the calculation on how much tax I have to pay on Social Security.
That's right. That should stay the same.
That should stay the same.
That's exactly right. So the income stays the same. The deductions are changing.
So, well, when they when they say you can put the on a postcard size.
They're selling something, right, Jack? They're selling. They want this to give everybody the impression that this is so good. You can't do this on a postcard. The income's still the same. There's going to be 21 lines of income as before. The credits for earned income credit, child tax credit, the American Opportunity, they're still there. Right now the tax or the credit for Obamacare is still there. So the income's still there, the credits are still there. That looks really good what they're saying, but don't believe it.
Sounds like smoke and mirrors.
Right.
Yeah, so you're saying that the calculation that is done, which you're well aware of, you do that. If I came to you to get my taxes done, that calculation that you'd have to go through
is the same.
Social Security, you'd still do the same calculation.
Yep,
Absolutely.
that worksheet's still the same.
All the income is still the same.
Okay.
Okay?
All right.
Thank you, Jack. I'm Esther Golias, the tax lady, 8030930, 8030930, star 930 on a cell phone. And that's what's so misleading. You know, they come up with these postcards things. You always could have done your tax return on a page 1040 EZ, right?
Yeah.
I mean, if all you got is a W-2, they would have done the calculation for you. That's always been
right.
true.
They even had telefile in the past.
Right. I mean, that's always been true. But what they did was they were taking away people's personal exemptions, taking away the benefit for being head of the household, taking away student loan interest, taking away and people just bought it hook, line, and sinker. It is remarkable because the only deductions that were available to middle income and lower income people. Upper income people lost it as their income went up. So
that was all we had.
It breaks my heart for people.
Yeah.
Anyway, why don't we go back to the phones? Julie. Hey, Julie, how can we help you, my dear?
Hi, Esther. Thank you for taking my call.
Yeah.
My question is concerning my husband. My husband passed away in August of this year, and I'm concerned now. He had no will. He had no life insurance. There was a $5,400 bank account in the same bank where my accounts were. The bank told me that they could have me sign an affidavit and then add my name to his account, and that way I inherited that money.
Sure.
And it became to my disposal.
Sure.
What I'm worried about is am I going to receive some sort of a document from IRS that has to be filed that shows that is income, or is there something? What I'm concerned about.
Make Julie feel happy, you guys.
Yep. Well, since it was just a regular checking or savings account that was inherited, that is tax-free. So there's going to be no reporting of that at all. You don't have to claim it. That's just your money.
All right. I'm concerned about it because we qualify for EPIC, and I wanted to be sure that all of a sudden I wasn't over the...
No, you're fine. You're absolutely fine, Julie.
All right. Then the other...
Sorry to hear about your loss.
Thank you. Now I also am asking, how do I file this year? Do I file...
You'll file just like you would have if anybody has a marital situation and your spouse was alive 1 minute during 2017 and you were filing jointly in the past, you have the right to file jointly for all of 2017.
Oh, I see. All right. So in next year then, when these tax changes come, how is that going to affect me as a retired person filing with that small amount of money? Actually,
Well, your next year you will revert back to a single taxpayer unless you have children at home.
all right. So do I lose my when I go to my tax person? Is she going to tell me that I'm losing my own exemption? Is that what this new?
Yes. Well, the person in 2018, nobody's going to have a personal exemption. The personal exemptions are gone.
All right. Well, you can tell that my income is below $29,000 a year.
Okay, but
That's
see,
great.
the thing is, next year you'll be single, and is that 29,000 including Social Security?
Yes.
How much of that is Social Security?
How much is Social Security?
How much of the 29,000 is Social Security? How much of your 29,000 is Social Security?
Hold on just a second here.
Well, how much a month?
That's $21,288 now.
All right, so you're going to have $8,000 in other income, correct?
And I have a small pension from my job.
And so if you take 21,000 from 29,000 means you have $8,000 left, right?
Mm-hmm.
So you're not going to have a tax problem at all in 2018.
You won't even have to file.
You won't have to file.
I know I don't need to, but the reason I do is because I want to file for New York State to prove every year that I get.
Okay. Yeah, but the bottom line is you won't have any taxes.
Okay. All right.
Okay.
So much for your help.
All right. Thank you, dear.
And it shouldn't change
Merry
your
Christmas.
Epic either.
I know we're getting close to the news. I'm Esther Golias, the tax lady, 8030930. 8030930, star 930 on a cell phone, and our toll-free number is 1-800-616-9236, and we're kind of talking about how the new tax laws will affect you for 2018. 217 is still the same, and you want to make sure that in these next 29 days that you take and pay for as many deductible items as you can, because next year you won't be able to deduct them. Correct, guys?
Correct.
In most situations, right?
Yep.
Okay. Are we ready for the news right now?
Yes,
Yep.
Frank's
Okay,
nodding his
We're
head.
going to take a short break for the news, and we'll be back on the other side.
Ain't it fun?
Hey, this is Esther Golias, the tax lady from EG Tax. 8030930, 8030930, star 930 on a cell phone. Like, we only got like 29 days till this is all over, so we want to help you as much as we can. Okay, let's go back to the phones. We got Joanne from Wheatfield. Hey, Joanne, how can we help you, my dear?
Yes, thanks for taking my call. Do you think that the capital loss carry forward rules will be changing for 2018?
Nope. See, here's the thing. All the complexity, there's like 70,000 pages of tax law. It's all still there. What they just took away was the itemized deductions. That's all. I mean, for all intents and purposes, I would think that it used to be 35% itemized in New York State. I would think it'll drop down to 15%. And some of the people that can't itemize were people that had large medical bills, maybe second homes, large interest that they paid for mortgages. They were using their car in their job. They paid for their stock brokerage fees and all the investment expenses, casualty losses, alimony, the moving expenses, all gone. So, but as far as the way that they do the computation of income, that all stays the same.
Okay, so if I have a real estate investment that I want to sell, it doesn't matter. Next year I have losses, I'll still be able to use those.
Absolutely.
Okay, thank you.
Okay, dear. Thanks for waiting. I'm Esther
Good
Golias, the
question.
tax lady, 8030930, 8030930, star 930 on cell phone. You said something.
Oh, I just said that was a really good question.
Yeah, that's true, because what people don't know is that all the income's still there.
Yep.
All the way you compute it's still there. All that complexity is still there. They just said, well, we're going to give you an extra $2,000 to write off. But if you have you have more kids than this, then you're losing $16,200. But we're giving you two, but we're taking $16,200 away. Yeah. All right. So here's some things that you should do, and I know we got callers calling in. Medical expenses, make sure you get those paid before the end of the year. Your health insurance, make sure you get it paid. Dentist, if you got kids that are thinking about braces, haul them off to the dentist this year.
Yep.
And even put it on a charge card if you're able to itemize, because if you're in the 25% bracket and and let's say that you have $10,000 in deductible braces, save you $2,500 next year in 18, nothing. So, property taxes. If you have a second home and maybe you're thinking about paying those in January, if you pay them in January, they're not going to be deductible.
Right.
On a second home.
That's right.
So
do it.
we're just trying to get you to get the largest bang for your buck in 2017. Sales tax item. The sales taxes are deductible now when you buy a vehicle, and let's face it, we're in an 875 county. You're paying a lot of sales taxes, especially if you're a retired New Yorker who doesn't pay New York state taxes, but you want to make sure that you take advantage of everything on the federal. Think about buying that car now. This is good for the car dealers before January, because you won't be able to take the sales taxes in 18.
But you know what you just talked about the second home, it would never encourage me to buy a second home now. I mean. Oh,
it's absolutely. Well, another thing that they're doing is, it used to be if you bought a home and sold it within 2 years, if it's your personal residence,
right.
After 2 years, the first $500,000 in gain would be tax free. They've now moved that to 5 years.
Oh, yep, you talked about that.
So
yeah, that's right.
It changes your. So if you've been thinking about things, you really want to make sure you talk to your tax advisor to see how these changes are going to affect your bottom line, because they definitely will. Okay, the other thing is charity. Due to the higher standard deduction, most people, an elimination of the personal exemption, it used to be that let's say you had itemized deductions of $9,000 and that was all from charity, with your personal exemption, you got to take your personal exemption plus the 9. Now, the standard deduction, they've eliminated the personal exemption. The standard deduction is $24,000. So in most cases, people won't be able to take their charity.
Right.
So it'll be just going by the board. So if you're somebody that is a giver and you're thinking about giving, think about double giving this year, and paying it on December the 31st rather than on January the 1st, so you can get your deduction. Right?
That's exactly right. It's all about planning.
All about planning. Cleaning out your closet, same thing. Casualty losses. If you were somebody that was devastated by the flooding in Lake Ontario, the casualty losses are gone. So you want to make sure that you get your appraisal and everything before the end of the year, because you got to take your casualty loss on the 17 return. In 18, there is no casualty loss deduction. So too bad for you.
Yeah,
too sad.
God, all those people on Lake Ontario. God, yeah, they have to get it in.
Right, and then, of course, the other thing is business expenses. For those of you that have employee business expenses, your
job hunting,
salesperson, job hunting, maybe for your employer you have to do continuing education. Make sure you get those things in before the end of the year, because there won't be a 2106 anymore. So there's no place for you to deduct them.
Mm-hmm. Yep.
So just things you want to think about. I mean, for Christmas, you should get your spouse, if you are both professional people, think about getting yourself those things that you were going to put off until you had more money.
Put it on a credit card.
Do it now.
0% interest
right?
credit card. Yep.
Okay, let's go back to the phones. Hey, Nick from North Tonawanda. Nick, what can we do for you, sir? Hello.
Hi, I think you partially, yes, can you hear me?
I can hear you.
Partially answered my question. I'm a independent contractor, business owner. And how does it affect me? Am I still be able to deduct?
The way they compute your income is going to be the same. So now, are you a small? Are you an LLC? Are you a Schedule C
yes.
corporation? What is your business?
Two owners.
So you're a partnership.
Yes.
Right. Okay, and is it a professional corporation, or is it like, do you have a market or something like that where you're producing goods?
It's a construction business. So
all right, so you're going to be able to. I would say you're an LLC. I'm assuming, right?
Yes. Yes.
All right. So on your pass through, the maximum you're going to pay, depending upon which version is going to come through, you're going to be one of the people that are going to definitely benefit, because the pass-through is going to go to your personal return. And on the House version, they're talking about 24%, and on the Senate, I think the House is 25 and the Senate is 24%. So that would be maximum tax. So you will make out.
Okay, am I still be able to deduct my household, like
Your office and home?
Yes.
I have to tell you, the 8829 will not be deductible for people that are employees, but as far as I can see, the 8829 will still be deductible for small business people. That hasn't been eliminated on the Schedule C or partnership that I'm aware of.
Okay.
Okay?
All right, that answers my question. Thank you.
All right, thank you. Okay, let's go to Scott. Hey, Scott, how can we help you?
Hey, how's it going? I have an odd question. I got into one of those companies where I was business self-employed. I bought a whole bunch of inventory, and on my Schedule SE at the end of the year, I had leftover inventory. I got out of the company, and they bought all my inventory back.
Okay.
So now when I file this year, isn't that gonna? I wouldn't do a Schedule SE because I'm technically not self-employed.
Well, you're still going to do your Schedule C, and you're going to have ending inventory, which and then was sold. So in effect, you've been bought out for your ending inventory, and you'll end up with no gain or loss. So, I mean, Chris, you want to explain it?
Right. So on your 16 return, you had an ending inventory that will go over to your 17 return. So when the company gave you the money to buy out your inventory, that's going to count as part of your sales for 17. So
reduced by his inventory.
Right. And then you'll show no ending inventory, so that will bring that cost of goods over to page 1 of the Schedule C, so it would, in essence, zero out.
Right. So it's like an in and an out. The left hand's going to cover the right hand. The bottom line's going to be zero.
So I'm not going to have to pay any.
No. But you got to report it. You got to report it, but you got your ending inventory from last year, which is then covered by the sale of the inventory this year, and one's going to offset the other.
All right. So it's not going to look like I sold everything and made tons of money.
No.
No.
All right. That's what I was worried about.
Not if you do it right. It won't.
Well, that's the thing, doing it right.
Right. Well, that's the important thing.
Right.
Okay?
All right.
Thank you. Okay, let's go back to the phones. We'll talk to Joe from Tonawanda. Hey, Joe, how can we help you, sir?
Hey, how are you?
Good.
I got a question for you. We bought a rental property in Florida this year in October, and we're wondering, are we still going to be able to write off our expenses? Now, we kept it basically as a second home that we're going to use as income property, I guess.
Okay, so here's the thing. If it's a second home, in 2017, you're still going to be able to take the expenses, all right, for your second home. In 2018, if it stays a second home, the expenses won't be deductible. So what I would suggest that you and your spouse do is convert that property to
He said it was a
property.
rental.
No, he said he's been using it as a second home. He said
Well, we bought it as a second home. That's how we did the finance.
Right.
Right.
But
Right, but you're renting it out now, right, Joe?
Yes, we're renting it out.
Right. But what you need to do is you have to make sure that you comply with the tax law that says that you don't use it more than 10% of the time or 14 days personally in order for it to stay a business asset. So if you're renting it out for 100 days, you are limited to either 10%, which would be 10 days, or 14 days, because that's what they allow you to do, whichever is greater, and it still retains its business usage. You have to do an allocation and stuff.
But it sounds like good news for you. You're still going to be able to deduct it as a rental.
Right.
Nothing changes.
But only if he's complying with those days. So if he doesn't comply with those days, he's not going to be able to deduct the expenses. So you have to make sure that you don't use it more than 14 days personally during the year.
Better to go into an LLC?
No, because it all comes down to this personal use stuff.
Are you using it at all personally, Joe? Is the question.
About 2 weeks a year, that's it.
All right, so that's 14 days, right?
Yeah.
All right, so that's the important part, is how many days a year is it rented out?
It's available all year. We're trying to rent it out every day.
Okay, but how many days
We
is it
want to do
rented
it
out?
off before we retire and use it as a snowbird thing where we'll residence there for just over 6 months a year or whatever.
Okay, well then it's a problem, because if you end up using it as a second home, the second home mortgage interest and the second home property taxes will not be deductible. You have to keep that house as an investment. So at the point in time you convert it to personal use, you're going to lose the deductibility.
Okay. So it doesn't matter if we go LLC or...
It doesn't matter. It's
for right
personal
now,
usage.
For 2000...
Through 17, you're good. This year, you're good.
Yeah, the LLC, Joe.
Next year's a problem.
The LLC will protect your personal assets.
Okay.
Okay, that's what an LLC will
From a
do.
lawsuit.
Right. But for tax purposes, the LLC will have no impact on your tax return.
Okay.
Oh, okay.
What I suggest you do is, why don't you call us? You know, there's no charge, and we'll kind of steer you in the right direction.
Oh, that'd be great.
632-7886.
7886.
Yeah.
Thank you so much.
You're welcome, sir. I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on his cell phone. We're going to take a short break, and we'll be back with your calls on the other side. Hey, what I like about you, you like about me. I'm Esther Golias, the tax lady from EG Tax. So we got 29 days to skin the cat before all the deductions dry up. Before I get to the phones with Glenn and John and Mark, I want to mention some of these things in the next 29 days. Your investment expenses, if you're going to buy like a Kiplinger letter or whatever, do it now. Legal fees, if your attorney helped you to get taxable income this year, you can't deduct it in 18, but in 17 you are. Job searches, go look for a job. If you're going to write it off, now's the time. Educator expenses, if you're a teacher, that deduction's going to dry up. Student loan interest deduction they're going to take away. So it's a travesty that these kids are paying the interest that they are, but they're taking that away. The 6,000 pound vehicle that you use for if you have so it qualifies as a truck, and the expensing, that's going to go away at the end of the year. Employee business expenses, that's gone. So anything that you can do to front end load your expenses that you have the option to write off this year, that's good. Also, if you haven't paid your health insurance and in the past you've gotten away with not putting that on your tax return, they will not accept it this year unless you pay the penalty when the return is filed, or they won't accept the return. The other thing is pass-throughs. When they're talking about this reduction in corporate tax rates, just like that gentleman before that says that he and his partner have a construction business, that they'll qualify for the pass-through reduction. But personal service companies won't, like attorneys, accountants, they're going to pay at the higher rate. Ministers have to watch out, because with the 2106 gone, it means that their Social Security deduction that they used to be able to take for the non-reimbursed business expenses will no longer be there. So they might have to pay more Social Security taxes. People with children, once they're 16, they're just not worth it. Just got to kick them out of the house. I'm only kidding. Seniors over 64, the standard deduction, increased standard deduction, that's gone. And the New York State return is a big problem. So you want the best help. You can call EG Tax during the week, 632-7886, and we'll get you ready. And when we're doing tax returns this year in 18 for 17, we will keep you abreast. We'll take a look at your return and say, okay, this is what's going to change next year. And so we're going to give you the heads up so that you won't be like a babe in the woods.
Right.
Okay, let's go back to the phones. I think we got Glenn, right?
Yep.
Hey, Glenn.
Hello. Thanks for taking my call.
Yes, sir.
Horror of horrors. I'm just cleaning house this past week, and I got a 2016 adjustment to my federal and state. I found a 1099 hour, so I have to go back and report that amount to federal and state.
Well, wait a minute. Did they send you a bill?
No.
They didn't.
No, I mean, but they said, I mean, earlier in the year, the Bank of America sent me a 1099-R.
Yeah, so you got to go back and amend that return then to include the income.
Right. Okay. Now, just because of where the tax season is now, do I have to wait till
No.
January?
See, the thing is, if you owe them money, you want to get that thing filed as soon as possible to mitigate the penalty and interest that's accruing on any balance due. So get it in as soon as possible.
Okay.
We can do that amendment for you if
Right.
you need us to, Glenn. Just call our office at 632-7886.
But it's a 1040X and a 201X, okay? Those are the forms you need.
Correct. Okay, but I mean, in other words, people like you will file it right now, right?
We'll file it right now.
If I had it.
Absolutely.
Oh, all right. That's my question.
All right, thanks, John. Glenn.
Oh.
Have a good Christmas.
And then Chris wanted to mention our new app for anybody who wants to go to the App Store. They can download our new.
We have such a great app. I'm so proud of it. Tim Eliason was in charge of that. On that app, the tax law changes are there. There's a thing to take pictures of your receipts and store it, and it gets sent to us, and we keep it until you get your taxes done, and then we have all the information there. You can make an appointment on there. What else does it do?
You can make an appointment. You can check about your refund. Can't you? Doesn't it link to?
Links to the IRS and the states, your mileage tracker.
Right, a mileage tracker. It's really remarkable.
We can do
absolutely no charge. You just go to the App Store and you just go to EG Tax, right?
Yep. We can do push notifications. So, like when the Senate just passed, you could have been notified this morning. Hey, the Senate just passed their tax changes. What does this mean?
That's right.
And you could have been notified instantaneously.
Absolutely, and you can make an appointment online too. Right?
Correct.
All right, that's good. So it's the EG Tax app. All right, let's go back to the phone. We'll talk to John in Lockport. Hey, John. Hello, John.
Oh, good afternoon, everyone.
Hey.
Good afternoon.
So I own a house here in Western New York, free and clear, no mortgage on it and what have you. I've recently purchased a home in Florida, which I do have a mortgage on. So I guess I'm asking, what about the interest on the mortgage and the taxes in Florida?
All right, so the thing is, everything I'm reading, the only interest that's going to be deductible and property taxes would be on your primary home. So either that house in Florida becomes your primary home or there won't be any deductibility. But I have to tell you, with $24,000, the elimination of the personal exemptions and the increase in the standard deduction, it's going to be a tough number to come to anyway. How much are your property taxes in your Florida house?
They're only $1,100.
All right, and how about your mortgage payment every month? How much is it?
$308.
Yeah, so you're not going to be able to deduct it anyway because the standard deduction is going to be too high, so you're going to get no benefit for it.
You might want to turn it into a rental unless you.
But that's true.
Yeah.
Tiffany's right. If you turned it into a rental and fall within those guidelines of 10% of the time rented up to 2 weeks, then you'd be able to deduct it on a Schedule E.
So, Esther, not to take up your time, should I become a permanent resident of Florida?
Well, it won't be deductible anyway because your standard deduction is going to be so high. Whoever crafted this tax plan was brilliant at how to take advantage of the middle income person because they doubled the standard deduction but took away the personal exemption. So it's very difficult for average people to itemize.
I think
very
you
difficult.
should.
Unless you have gigantic taxes in New York State, it's not going to work. So Tiffany's got the best suggestion: turn it into a rental. But call us; we'll give you the ins and the outs.
Okay. Thank
okay.
you so much.
You make me laugh. You're so funny. Brilliant who wrote this to how to take advantage of the middle class person.
Well,
I think that's very eloquent.
I'm going to tell you, people are drinking the Kool-Aid left and right. Let's go back to the phones, and we got who? Mark?
No, we got Rose from West
Hey,
Side.
Rose.
Mark went bye-bye.
Yeah, that was Mark. Hey, Rose, how can we help you, dear?
Hi, Esther. I'm a retired person. I haven't done tax for a while. I go to your company, and she checks me out, but I have a stock that I inherited in 1999. It was worth $53 a share. Now it's worth $12 and change. and I'm just holding on to it. I don't need it. But I was wondering, should I be getting rid of this or?
Not necessarily. I mean, obviously the stock is going down. How many shares you got?
672.
All right, so you have $8,064 sitting on the table. If you sell it, it's going to be a tax-free event because you lost money.
Right.
So if you want to ride it down all the way to the bottom, or do you want to redeem it while you got some money? Unless you think that it's going to become the new up-and-coming stock, I think I would think about getting rid of it.
Same way, like now, I would have a capital loss, and
yeah, you're not going to have a tax problem.
Have to let
the whole thing is you're just sitting on $8,000 that's getting smaller and smaller.
Understand, but she told me, oh, that's okay, we can take care of that.
Right, that's true. I mean, we have to report it, but it's not going to cost you anything.
But am I going to be affected in 18 that's going to go away, or?
No, you'll be fine.
Oh, I'll be okay then.
You'll be fine.
Oh, okay, that's all.
Okay, my dear. All right, thank you, Rose.
Yeah.
I'm Esther Golias, the tax lady from EG Tax. I think we have gone through all of our callers.
There's one more coming in.
But I think we're almost out of time.
All right, but we're down to our last couple of minutes here. So here's the important thing. If you're an itemizer and you know who you are, you have a 29-day window to increase your itemized deductions through 2017 to get the biggest bang for your buck. I will tell you, if you take a look at the tax brackets that are changing, for instance, I'll give you an example. If your itemized, if your taxable income is between $400,000 and $1 million, you're going to save about 40. Let's see, on 600,000, you save $24,000 in taxes. That's a big tax savings. However, if you're a family of 4 and 2 of your kids are 17 or older, you just are going to end up paying an extra $1,200 in taxes. So if you want to find out how this is all going to affect you, give EG Tax a call at 632-7886. All of our offices will be open in mid-January. Don't wait till January to make your appointment. You know that we book up kind of quick, and we would love to help you. If you have any questions, you can go to our website at egtax.com. Go to the App Store, download our EG Tax app. It is so cool. You can be at the restaurant, and for business, take a photo of your receipt, or you're paying bills, photo your receipts, and we'll store it actually we don't even store it in the cloud. We store it right in our website, so and we watch it and take good care of it. So until next week, I'm Esther Golias with Tiffany Fabian and Christopher Fabian from EG Tax. If you need the best tax help for the least amount of fee, give EG Tax a call. We are honored to help you. Have a great week.